Okay, guys, the next price phase we're going to talk about is the price reversals. So what's the price reversal? It's a market condition where price expands and quickly moves in an opposite direction to where it's coming from. Could either be after consolidating or in the trending market. So you can see the example here. You can see how price was consolidating. Price ran lower, took liquidity, and it rallied higher. So this is a reversal, example of a reversal. Now you can remember this chart here, this diagram. It all starts from the consolidation. So market moved from consolidation to expansion. From expansion, it could either go back to a consolidation, and it could either reverse or it could either retrace. But for a reversal, price could either expand, reverse, and expand, or reverse, then consolidate. So like the previous example we saw, this move here is an expansion. So price expanded lower. After grabbing liquidity, it then reversed. So as price reverses, it could either consolidate or expand higher. This reverse is just a quick change in direction. So price was going lower, took this liquidity and then change direction. So that's the reversal. So as soon as it reverses, what happens? It expanded higher. I hope you understand. So reversal is just the change. So price expanded lower, reversed, that's change direction, and then expanded higher. So price cannot reverse and retrace. It's not possible. So we'll go back. You can see price can only reverse, consolidate, reverse, and expand. It cannot reverse and retrace. So after a reversal, the next thing we are expecting is what? An expansion or a consolidation. Just like pairing another price phase with a reference point to generate a trade idea or a trade setup. So to get a trade idea or a trade setup with a reversal, you pair it with a liquidity pool. But let's look at an example. Remember I said buy side liquidity rests above swing highs, while sell side liquidity rests below swing lows. Now you can see how price purged the liquidity above the swing high. Here, this is buy side liquidity, price reversed. And before doing that, you can see how it took the liquidity here and reversed higher. So you can see another example. You can see how price took out the buy side liquidity and then reversed before going lower. Took this buy side liquidity and then went lower. And then took out the sell side liquidity, reversed, and then here. So here's a very good example of price reversal being paired with liquidity pools. So once price purges this liquidity, it forms what? A trade idea. Other things you can combine to form as confluences to help you know when to take a trade. Another very good thing is if you have a good entry model, you go down to a smaller time frame to look for a confirmatory entry to let you know that price is ready to go higher. So a trade idea with reversals is paired with liquidity pools below and above price. In a bullish market, when price is set to run higher, you look for liquidity pools below price to execute your orders. While anticipating a market reversal, a run on liquidity sets the tone. So what this means is if you predetermine price to be bullish, what you want to do is you want to look for sell side liquidity below swing lows and wait for price to dip below those sell side liquidity to grab liquidity. Now, once price grabs this liquidity below price, it forms a trade idea. At this point, I would like to differentiate between a trade idea and a strategy. A strategy is built from a trade idea. A trade idea or a trade setup is like the skeleton of a trading strategy. A trading strategy is a refined trade setup. So it means that you don't just buy when price runs liquidity. There are other things you may want to add as confluences. There are other entry models you may want to include. When you bring this together, you form a strategy. So all I'm just giving you is a trade idea, meaning that you have the opportunity to form whatever strategy of your feet. All right, we can see now, this is an example. Let's assume this is where price currently is, and you predetermine that price will run higher, okay? So all you need to do is to look for sell side liquidity. Once it's purged, it forms a trade setup. Okay. So at this point, as soon as price rallied, it retraced, created a swing low, and then rallied higher. And this swing low, you're expecting that once price takes this liquidity, it will rally higher. So you are waiting for this to happen to form a trade setup. Then here's another example. Price rallied higher, retraced, and then formed a swing low before rallying higher. And you can see this high was not taken yet. So this has a very strong probability. And you can see how price took out this low before rallying higher. Then we have another example here again. Price retraced, formed a low, and then price came lower to take this low. Then now we can see how price reversed as it took this buy side liquidity. So we want to be mindful of taking partials as soon as price breaches the swing high. So you can see this high was breached here. So you want to be taking partials. If you're in a swing trade, you want to be moving your stops as price keeps hitting these highs. And you can see what happened there. This big reversal as price takes out this buy side liquidity. A high probability setup is formed when a run on liquidity is combined with an institutional level. Let me show you an example. So you can see how price was consolidating here and then reversed. Before reversing, we can see price was paired with what? Liquidity pool. But if you look to the left, there is something here. I haven't spoken about it yet. We're going to be talking about this concept in the lectures coming forward. But here is a bullish order block, the ICT bullish order block. So you can see as price was taking this liquidity, it was finding support where at this bullish order block. So when you pair higher time frame institutional levels with this trade setup, it increases the probability of price moving in that predetermined direction. In conclusion, reversal is the sudden change in trend direction after a liquidity grab. Price reverses at areas of liquidity. A high probability setup is formed when a run on liquidity is combined with an institutional level. So here's a homework for you. Go to your chart, mark out areas of price running liquidity, and then study price movement. What does it do when it grabs liquidity? Does it reverse or does it continue in the current trend direction? And then you want to study the characteristics of what it does when it reverses and when it continues. Now, I'll show you an example. If you look at this example here, when price grabs each liquidity, you will see that wicks are being formed. There was not any full body close below this low. I don't know if you understand. The same thing here. Price does not spend much time when it wants to reverse. Although we can see an exception here. There was a full body close. But let's go to previous example. Now you can see here, wicks are being formed. As price takes out this low, you can see this wick was formed. Price takes out this high, you can see wick was formed. Here again, wicks, although here we can see full body close and the wick. So when price is to reverse after taking liquidity, we see that it does not spend much time. So let's look at the example here. You can see this low. This is market taking out liquidity. So you can see as price broke this low, you can see how price kept going lower, kept going lower. So we are not expecting any reversal. You can see 1, 2, 3, 3 candles already closed below this low. So we are not expecting any reversal here. But as soon as price grab this high, you can see just a week, 1, 2, price rally lower. So that's just one thing you can take note of. You can do this in any time frame or pair of your choice. So if you're enjoying these videos, you're learning a lot, please like this video. And if you're not subscribed yet, do subscribe. And as always, I wish you good luck and good trading.